at Uniathena. Uniathena is a higher educational services providing a quality degree like masters, short courses, and doctorates. We have a webinar on the topic accounting standards on financial reporting for business. Before starting, we are glad to inform you that you will be we will be providing you the certificate for participation to all the participants. Thank you once again for giving us time and being the part of this webinar. It is requested to mute the mic and ask question at any point throughout the webinar using the chat box, which is at the bottom of your screen. So you can raise the hand button if there are any queries or any question you can ask to Mr. Asim directly. So I would like to take your attention to our courses that are postgraduate diploma in financial risk and management and essential of accounting system and procedure, which will help you to understand the fundamentals and the advanced features of finance and accounting. The links are provided here. You can have a look on this course as well. Now let me introduce to Mr. Asim Mahmood, who is an expert in accounting and finance. He is an accounting and finance program leader, a Pearson PTech faculty, and a internal verifier. He has a vast experience as a business management lecturer, a freelance corporate trainer, and he is responsible for company's productivity by providing various training programs as per requirement. Thank you. We will begin shortly. Over to you, sir.
Okay, thank you very much, Mr. Agra. So in today's session, we will be discussing the influence of accounting standards on financial reporting for business. So let me give you an overview about the financial reporting. Like what is financial reporting and why do businesses need to do the financial reporting? So the first and foremost thing which we knew in today's world, the growth and expansion phase, the very exciting time for the organization as well as for the businesses and industries to grow. And at the same time, it will be creating new opportunities. It will be having, you can say, a lot of other possibilities where where you can say organizations, where you can say MNCs, they are coming together and having you can say merger acquisitions, and they are basically globally coming together to conduct business or economic activities. So for that purposes, basically financial reporting creates, you can say, new opportunities which will bring new customer, generate more revenues, higher the profits, and at the same time, if organizations, if businesses, they have got the lack of financial reporting analysis and capabilities, then it will be a very difficult for them to make good informed decisions and how to best manage and grow the businesses. So financial reporting is one of the most critical business process that accounting, finance, and businesses must understand and appreciate. Financial reporting is the comprehensive review of monthly, quarterly, and annual, you can say, data and information by establishing financial reports. And financial reports, we normally discuss about income statement, we discuss about balance sheet or statement of financial position, and we also discuss the cash flow statements. So all of those statements will be recorded, summarized through financial reporting. A timely and accurate financial reporting process will help the business to understand the performance and identify the opportunities to make right business decisions for future growth. Then why financial reporting is important for everyone? So financial reporting, basically, it's important for everyone, especially for the businesses, and within the business, the finance department, they have to take care the financial needs, the financial, you can say, affairs. And at the same time, there are a number of, you can say, departments which are connected with the financial, you can say, affairs. So Financial reporting, at the same time, it will be helping to the business partners. It will be helping to the departments of, you can say, leaders, stakeholders. It will also help, to take the, or you can say, make the strategic decisions at the same time, of the company operations for the growth and expansion, and then the future, you can say, profitability based on, you can say, financial health. So all of these activities are done in financial accounting. Then, once we discuss the reports, like financial accounting, we normally, you can say, discussed and used for making the financial reports. So these reports will be helping to number of parties which are connected either directly or indirectly with the business. So once they have the stake on the organization, so they will be interested what's going on within the organization. Either those are the internal stakeholder or the external stakeholders. So let me give you one example. From the external point of view, stakeholders who are the potential investor, they wants to know what's going on within the business, and how you can say business is doing well. What is the current position? What is the current, you can say, financial health of the business? So from their, you can say, point of view, you can say, to make the investment decisions, they have to rely on financial, you can say, instruments, financial documentation. Now, once we say they have to rely on those documents, at the same time, the financial reporting, you can say, role comes in. Like, how does these financial documentation instrument will be made, and how people, they will be creating, they will be, you can say, taking the help, they will be, taking a lot of, you can say, knowledge, information from these financial, you can say, reporting instruments to make their future, you can say, investment decisions. So then, most, you can say, critical business processes which are going on within the business, they are linked with the financial reporting. And then at the same time, it will be giving a comprehensive review. It will give the review of how does one particular assets, one particular liability, or you can say one particular instrument of income statement or balance sheet that will be benefiting, or that will not, you can say, benefiting to the organization, and how does the treatment. Basically, in the financial reporting, we will be discussing about different standards. So all of those standards will be providing the treatment of each and everything which is going on within the financial statement. Because I already mentioned, financial statements are the information, basically, or those instruments, at the same time those documents, which will be quite, you can say, helpful for the internal as well as external stakeholders. So once businesses, they start, you can say, making, they start drafting, these statements, they need to be very careful, because there are some certain rule, regulation, policies and protocols which they need to perform, which they need to, you can say, comply. And if they are not complying with those rule, regulation and policies, then their assignments are not, you can say, up to the mark. Their assignments now, which will not be approved, at the same time. Maybe the governments, they are not approving, maybe the other, you can say, financial institutions, they are also approving. So now you can see, like, how does this particular financial reporting is affecting our whole business, and how, you can say, it is important for the organization to take care each and every economic activity through financial reporting standards. Okay. uh, the next part is to improve business agility and partnership. So financial reporting basically provide, it will, you can say, track and analyze the business finance, as I already mentioned. So business finance is, basically, the finance is the backbone of any organization. If we can say, if businesses, they are able to manage the businesses, if they are able to manage the finance, so there, as you can say, the half of, you can say, problems, it's already solved. Half of, you can say, the things, the problems, or you can say shortcomings which are going through within the business, they are able to resolve through financial affairs. Then once we discuss about the finance, so there are number of other you can say aspects which we have to look. Let's suppose take the track of historical performance, and also based on the historical performance, we will be able to make or forecast the future decisions. And then these particular reports will be communicating with the business partners, with you can say community, with all those potential shareholder, stakeholder, or stockholders who are interested in your business, to you can say to be you can say at the same time, if the organizations they wants to get some kind of loans, they want to you can say the funds you can say requirement is there. So these you can say financial reportings will be helping the organization to get you can say loans on easy terms, and at the same time it will build the confidence of the financial institutions as well as the customers, general public, or the potential investor to invest in this organization. Okay. uh, at the same, as I mentioned, once they are improving the business agility, so there will be a lot of you can say instrument which financial reporting basically take care. So they may be making revenue, expenses, proper profits, as well as you can say capital, cash flows, and other you can say assets and liabilities, shareholders can say equity at the same time. So all of these you can say concerns will be conducted through you can say certain rule, regulation, and policies which organization needs to follow. And in today world, I will be discussing after that what are the different accounting standards, what are the different you can say rule, regulation, and policies and protocols which are established from different you can say countries, different you can say country jurisdictions. Then turn complexity into clear statement. Exactly. So financial reporting will be you can say simplifying the complex situation, the complex you can say statement, the complex data and information, as they are compliance with particular standards. So that standard is already mentioned. Normally, these standards which will be discussing on after we discuss about the financial accounting, the overview. Then all of these standards have got quite you can say weightage in terms of one particular activity, economic activities involved in the organization, one particular you can say activity involved within the business. So how does that particular activity will be recorded, and on what terms, on what you can say particular rule, regulation, and policies which organization needs to follow. Otherwise, their whatever the financial statements which they are producing, they are not you can say approved. They are not you can say taking or you can say more value. So financial statement again at the same time can translate into business understanding, connection, and action. Then financial you can say statement visibility and analysis, which is the part of financial reporting, because all of the financial statements are made and done according to financial reporting. Now, uh, maintain transparency. Exactly. Trust and solidify relationship. This is the first and foremost, we can say, role of financial reporting when it's come to transparency. Because once organizations they are making business decision, they are planning their budgets, they are you can say track you can say result. So they have to look on the data and information which is gathered, which is you can say collected from different departments, from different sources. Now, once organizations have collected their data, then they have to check, the health of the data, like how or does that particular data information health will be affecting to the financial reporting, because that particular data will be used by the business analyst. That data will be used by the auditors and some you can say other you can say finance people as well, who will be analyzing, who will be you can say writing their reports, who will be writing their judgments. So based on that data, we can you can say trust, and at the same time we can solidify the relationship. Then it will be you can say making it will be used for making the scenes, plan the budgets, and as well as track the results. Then it also provides the insights about the organization, like what's going on in the organization, how does organizations is able to manage, how does organization is able to, you can say, perform the economic activity and at the same time. And once these particular activities are done, how they are recording, how they are summarizing. And once they are summarizing, based on that summaries, based on that outcome and results, the top level management, they will be taking corrective actions. They will be communicating, all of these financial reporting instrument with the employees, with the, you can say, supervisor, with managers, and also all of these instruments which we are discussing. It will be connected with the internal as well as external stakeholder of the organization. Ensuring, you can say, compliance and completeness, exactly. So core pillar for finance team and the business and executive has also to ensure that each activity, each, you can say, activity which is recorded in the financial statements, because every activity have got the impact on, you can say, on, you can say, related or linkage instrument, financial instrument. So once we discuss about the recording, so first, once we record some activity, it start from the journal. So within the journal, we record an activity. Let's suppose we have purchased something. So from the purchase, uh, what should be, you can say, asset which we have taken. So that, asset will be we putting normally on the debit side because of the nature of account, and then we will be mentioning the credit, you can say, cash on the credit side. But according to different, you can say, rule, according to, you can say, different policies, which that particular organization is, you can say, taking, and especially that particular country, or which particular accounting applications they are taking. So which I have already mentioned here as well, GAAP and IFRS. So according to GAAP and IFRS, how does that particular activity will be recorded? Because that activity, that particular transaction will be, once it's mentioned in the journal, so it will be going to the trial balance. After the trial balance, it will be making a separate, you can say, ledger. After the ledger, this particular, you can say, transaction, recording of basically transaction will be mentioned in the statement of financial position, and at the same time with this statement of financial position, it will be mentioned in the cash flow statement. So if that particular activity, if that is no particular, you can say, economic activity which business have conducted, if it's not recorded according to IFRS or GAAP, then they will be facing a lot of complications. And that's the reason, the international bodies, international, you can say, accounting bodies, they have established GAAP and IFRS. So there are several, you can say, other financial regulatory institutions are also there, which will be connected with these bodies. And if we discuss about the GAAP and IFRS, so basically both of these GAAP and IFRS providing the information how to, you can say, record each economic, you can say, transaction within the business. And they will be providing the rule, regulation, policies, guidelines, and each, you can say, body, accounting body have got, their advantages as well as disadvantages. They have, their limitations as well. So yes. So then the third, you can say, instrument, which we'll be discussing, that will be financial statement, and then we will be moved to our main, you can say, topic, that will be financial standards, accounting standards. So another one which is mentioned, that is cash flow optimization and inspection.
Mr.
So in
Asim, we have one question
yes,
which is
please.
related to gap. Are you
Yes, yes,
can we ask?
yes, yes, please, yes, please.
Yeah.
Go ahead.
So Davis, one of the learner, is asking: is it the only US based that use gap?
Sorry, is it?
Is it the US?
Yes. Yeah, exactly.
That's
This
it.
is, I was going to, you can say, discuss in my next, you can say, slide. So then we will be discussing about GAAP as well as IFRS, because GAAP is based, or you can say, utilized and applied in US only. solely, and then the rest of the world, like almost 144 countries, they will be using the IFR application, and that is, you can say, more practical, more applicable. So this is what we will be discussing after that. Yes.
Thank you. Thanks a lot.
Okay. Then we will be discussing about the cash flow optimization and inspection. So important key performance, you can say, indicators, track, you can say, the analyze cash flow and outflow, and then sufficient, you can say, cash flow finance team have to take role. As I already mentioned, once they establish the cash flow statement, so each economic activity, once they are recording, because in the accounting and especially in the financial reporting, we have to rely on these, you can say, transaction which is recorded. But how does that particular transaction will be recorded? These, you can say, GAAP as well as IFRS accounting bodies, they will be providing us the information. So important, you can say, key performance indicators will be, you can say, will be established, by these awarding, you can say, bodies at the same time. And then it will mention how does that particular transaction will be recorded. Okay, yes, now we are coming to the GAAP, that is generally accepted accounting principle. So GAAP accounting rules, and there are also, you can say, financial reporting standards. It is, you can say, required by for the, you can say, publicly traded companies at the same time. And then the GAAP application basically ensure that financial reporting is transparent and consistent basically. So it is the same, you can say, guidelines which is mentioned here, the same, we can say, principle which is mentioned here. We can see they will be the same principle will be happen, or will be, you can say, mentioned in the IFRS as well. So both GAAP and IFRS, they will be go hand in hand. But at the same time, as I mentioned, there are some limitation where GAAP having, some, you can say, lapse, where GAAP have, some, you can say, limitation in terms of accounting of that particular, you can say, event transaction. So I will try to identify, those events as well. So effect of, you can say, investment decisions at the same time. So this is the, you can say, another principle. Yes, GAAP and IFRS. This is the question which I have already, you can say, expected. So GAAP and IFRS, basically GAAP enables the last in and first or inventory cost. Now, as I have mentioned, GAAP is working, it is, you can say, applied within the US. GAAP is having, it is basically based on the rule. It is based on the policies which is governed by that particular state, you can say, finance department. And now once these rules now have made, we cannot change, we cannot go beyond rules. But at the same time, these rules are quite, you can say, rigid in nature, because again, those rules now, once they established, they are established by the humans itself. So there are, some limitation, there are, some, you can say, gaps which IFRs now have, you can say, quite a good advantage at the same time. Because if we use IFR application, so it will give us, you can say, more clarity, it will give us more, how you can say, confident at the same time, and it will give us the right information, the right, you can say, analysis at the same time. So the first and foremost thing which, I have mentioned here as well, first in, first out inventory cost method. In GAAP, they used you can say, last in first out inventory method, which IFRS say it will be not used, in their application. And why they are not using? Because I will be mentioning few example after that. So within that numerical example, you guys will be able to understand how does, if GAAP is not is utilized by the US for last in and first or inventory cost method, and why IFRS they are avoiding, they categorically mentioned we are not using this method. As I mentioned, from their point of view, if we take the analysis, if you take the, you can say, financial analysis for each, you can say, clause which is mentioned in the GAAP, and at the same time that is that particular clause is mentioned, that particular rule is mentioned in IFRS. So both have got no quite, you can say, big contradictions. Uh, they will be, you can say, having profit impacts, they will be having, you can say, cost impact. Maybe in the gap, once we use the last in first on first, you can say, out inventory method, so the profit will be overstated. But at the same time, if that particular, you can say, economic activity recorded, or you can say analyzed, summarized in IFRS, the profit will be understated. So that's the reason, once companies, especially in the US, because it is quite, you can say, talk of the town, in today accounting world, they have, you can say, make, their reservation. They have got, their point of view, like, if we are using last in first out, you can say, inventory, you can say, costing method, then our profit will be, you can say, under cost. If our profit will be under cost, it will not show the exact picture, the exact, you can say, financial health of the organization. Then at the same time, organization will be saving billion of dollars, because they have to pay less tax. And IFRS, awarding body, they have categorically mentioned, if we are using that particular, you can say, method, that is last in first out, then they will be getting the exact picture. They will be getting the exact, you can say, financial health of the organization, and then they have to pay more taxes. They have to pay, you can say, taxes according to their, you can say, profit, which they have, you can say, undercosted. And at the same time, the treats, you can say, development cost, such as creation of software or other intellectual property, as an expense. So there is another difference when it's come to the different development cost. When it's come to, you can say, intellectual property, they mention that it will be treated as expense. But in IFRS, once they mention that capital investment, that is expense, and amortize over time. Now, if we see, on a, you can say, if we see on a broader terms, so we can say, like, this particular, you can say, gap, between gap and IFRS, which you have created, you can say, limitation, I might say there is a limitation basically between the two, you can say, accounting awarding bodies. It is because of one particular, you can say, accounting awarding body. They mentioned that intellectual property as expense. But at the same time, the other, you can say, accounting awarding body, they say this is the, you can say, capital investment, and it will be amortized over time. So there is a huge difference now. We can see, like, expense and amortization, capital investment. So they are taking as a capital investment, but here they will be taking as expense. So once they're taking as expense, again, their cost will be lower, their profit will be increased. But on the IFRS side, this is the capital investment which will needs to be amortized over time, and it should be, you can say, to mention, it should be, you can say, available, from the taxable, you can say, profit point of view. Then does not allow reduction in value to be reversed. Yes, that's another drawback, between GAAP and IFRS. It does not allow that if over the period of time, one particular asset, with you can say, with passage of time, when its use notes, you can say, original value because of the usage. So it does not, you can say, reduce the value to be reversed. But at the same time, in IFRS, if inventory or asset values that will be write down, it will be reversed. So that reversed, again, the method, it is not available in the gap. Then record, and you can say, reports and fixed assets, and enable business to adjust fixed asset at their fair market. Again, they are just recording their and reports on the fixed asset. But at the same time, IFRS will be providing the adjustments, and those adjustments which will be made on fair market value. So there were few, examples, which I have mentioned here. We can see which particular accounting, you can say, awarding body having the lapse and gaps now over other. Then there are, some of the principle of gap which are mentioned here. So the first principle, which is mentioned here, that is regularity, as well as consistency, sincerity, permanence. And then they have mentioned non-compensation, prudence, continuity, periodicity, materiality, and then good faith. But all of these principles will be available also in IFRS. So let me move to the yes. Yeah. Now there are the key reports which we have I think previously discussed, like balance sheet, profit and loss, you can say report, or you can say income statement, cash flow statement, and then
Mr.
shareholder.
Asim, we have another question.
Yes,
It
please.
regards with gap only. That's why I have to ask. Can you imagine?
Okay.
One of the learner is asking that is gap only specific to countries?
Normally, countries who are you can say linked, or you can say who are, you can say maybe strategic partner with US, uh, they are all, you can say, using. But again, not all. It is
Yes.
very, you can say, unfortunate to say, this gap application is very very limited now, and
And he is also asking that because some of them are allowed amortization, some of them.
yes, yes,
Yes.
exactly, because a gap, normally it's going to, you can say, limit in the US only in future, maybe in coming 5 years, 10 years, and then they have to change basically. And they have made some, you can say, some memorandums with IFRS, like on certain, you can say, economic activities, we should, you can say, record that particular transaction by using these regulation, by using these, you can say, terminologies. So again, as I mentioned, once now we discuss about the gap and IFRS. So we normally say gap, that is based on the US, and the rest of the world, they are going for IFRS. So they already mentioned 144 countries is the quite, you can say, huge amount, who are, you can say, making the application, because maybe the rest of the other countries, they are not using gap, they may be having their own, you can say, accounting standards, their local standards basically, which they are using. So that's the reason, they have, quite, you can say, big, limitation, gaps and lapse, between the two awarding bodies.
So another question
Yes.
is from the same learner. In terms of regulation, he is asking that what does OECD in terms of accountant stands for?
uh, OB.
CD. Where does the OECD fits in terms of our work as an accountant?
Sorry, I'm not getting your question. Can
It's
you?
Organization for Economic Cooperation and Development. So
Okay.
how this helps in terms of regulation as an accountant?
Okay. As I already mentioned, all of these, you can say, regulations which are mentioned in the GAP as well as in IFRS, they will be having, the guidelines. Now, that particular guidelines will be, you can say, coming under the jurisdiction. Like, okay, this particular business, they are conducting that particular activity. This activity should be linked with that particular class, that particular rule, which is mentioned in GAP or IFRS. Both, we are taking, both, you can say, accounting bodies together. So now, which particular activity they are, you can say, performing in that business, and the nature of activity is a very very important, because each activity have got number of, you can say, rule, regulation and policies. And one more thing which I would like to mention, if we see the manual, the handbook of GAP, and if we compare the handbook of GAP, where, they have, you can say, established the FASB, basically Financial Accounting Board. It's come under Financial Accounting Board. So they have established, quite, you can say, details about each and every economic activity, you can say, how to record, that particular event. But you will be surprised, that particular manual have got around 25, you can say, thousands, word, you can say, pages. It is, they have mentioned, because it is that much comprehensive. I'm discussing about the gap. But at the same time, when we see the IFRS, they are having, a very compact, very, you can say, precise, you can say, regulation and policies. Because as I mentioned, gap, they will be having rules, regulations, which will be, you can say, established by that particular, you can say, country, especially, in the US finance department. And at the same time, IFRS it is based on principles. So when it's come to the principle, you have some you can say leniency in terms of, as you can say, business analyst, as you can say auditor, or you can say as an independent you can say finance personnel. Like once you have got some kind of, you can say, gaps or labs, some errors which you need to rectify within the financial statements, so you can put your you can say suggestion, recommendation, you can do some kind of adjustments. But as I already mentioned, the gap have no have gap doesn't have that kind of, you can say, facility. So they will be providing certain rules, and we have to follow those rules once we are establishing our financial you can say statements. But in terms of IFRS, yes, they will be you can say a bit lenient, lenient in a sense. These are the principles, these are not rules, these are not, you can say, some you can say protocols, these are not some kind of you can say rigid guidelines which we have to, you can say, use, we have to, you can say, utilize. So that's a different that's a reason these both you can say IFRS and a gap have got this much you can say gap within both accounting abiding bodies. Okay. Yes.
Thank you. Thank you.
Yeah. uh, then financial you can say reporting, there will be a global perspective. The global perspective which we are taking, that is normally support the goals of, you can say, single set of high quality and, you can say, global accounting standards, IFRS, you can say standards, transparency, accountability, and efficiency. Again, the standards you can say principles which we have discussed in gap, you will see in IFRS as well. But when it's come to the applied application part, so both are applied differently. Both are, you can say, both are, you can say, making the calculation for each economic activity differently. Then IFRS standard does not come out without you can say cost and effort. Exactly. That is again another perspective. Let me tell you one more you can say perspective from the gap. So basically, US companies, they are required to follow, and which does not, you can see, leave much, you can see, room for interpretation, because they did not mention which particular activity, how it needs to be interpreted, how it needs to be, you can say, narrated. But IFRS at the same time, basically they focus on the principle. So those principles they've mentioned, we can interpret, we can, you can say, make the narration, we can provide detailed information about you can say economic activity, because based on the narration, based on, you can say, interpretation, we, as a general public, we can see how is the health of that particular company or that particular, you can say, business which which they are doing. So then as I already mentioned, it is quite, you can say, detailed if we discuss about the gap. But at the same time, we are getting IFRS, which is quite compact, quite, you can say, to the point, things which they have mentioned. So yeah, that's the reason they have got you can say quite you can say limitation at the same time. Now IFRS standards. So again, it will be used for the companies reporting, securities regulators, and accounting professionals. IFRS has brought a net, you can say, benefit to the capital market. And how does now they will be, you can say, affecting the financial statements? Because as we have discussed about the IFRS, it will be making a quite, you can say, positive impact in terms of the right picture, in terms of the true picture of the organization, like how that particular organization is doing, and what is the financial, you can say, health, what is, you can say, financial the things now which that particular organization is going through. So it will be giving a quite, you can say, better idea, quite, you can say, clear idea as compared to the other standard, that is gap. Then international, you can say, financial reporting standards, which will be uh, which will be used for each and every, you can say, economic activity. So now when we say the international accounting board standards, so there are some reports, there are some, you can say, post implementation reviews for each you can say new IFRS standard. So again, In GAP, normally, the rule regulation which is mentioned, in their manual, it is really hard for them to change, because there will be, certain, you can say, assembly member, they should be present. They will be taking part, for making the amendment or changes in that particular law. So they will be using, their voting power and all. So it will be quite hard for them once one particular rule is established. Even though normally, the companies who are in the US, they knew like this particular standard have got some issue in a sense, like, they are not, you can say, applying accordingly. They are not, you can say, able to, you can say, get the effective, or you can say, appropriate result at the same time. And that's the reason, PR basically, is an opportunity for IESP, that is International Accounting Standard Board. Now, IESP, the IFRS come under IESP. As I mentioned, the gap, it is come under FASP. So IESP assess the objective of the standard setting project. Then standard is useful for the financial statements again. So they will be quite, you can say, helpful in terms of you can say, making the transaction. And also they will be changing, they will be, making the amendment. Let's suppose one particular principle have got some issues, and they are not able to, you can say, apply. They're not able to, you can say, use the correct, you can say, application of that issue. Then they will be making some amendment, they will be making some changes. So that's the reason it will be updated. Maybe you can say, after, you can say, 1 year, 2 year, they will be making changes according to the time, according to the requirements, and according to the nature of business as well. Okay. Then now, as I mentioned, International Accounting Standard IAS, that is inventory evaluation. So inventory shall be valued at lower of cost or net realizable value. Now, this is the standard. This is the rule. The rule which is mentioned in international, you can say, financial reporting standards, IFRS, they have categorically mentioned this particular rule should be applied by the organization once they are establishing their financial statements, once they are establishing their financial, you can say, documentation. Now, for each, you can say, economic activity, they have got a different definition. Different in a sense, once they are making the interpretation of cost, once they're making the interpretation of net realizable value, that might differ in GAAP. So the cost, purchase price excluding trade discount plus all the costs incurred in bringing that inventory to its present location and condition. So all of these, you can say, points, which they have mentioned in quite, you can say, detail, like, what things, which need to be excluded, what are the things which need to be included in cost. It is mentioned very categorically, and it will give you the right picture. It will give you quite, you can say, appropriate picture of your trading profit. Then net realizable value, that is NRV, estimated our, you can say, selling price less further cost to make saleable, you can say, that particular good or service. And then further, you can say, rework, that will be cost, marketing, selling, and distribution cost, that will be added after that. So once we are making the income statement, so first we are establishing trading profit. After the trading profit, the other items, which we need to, you can say, include in terms of, you can say, direct or indirect, you can say, expenses. So normally the direct expenses we mentioned in the trading profit, and the indirect expenses we mentioned in the profit and loss statements. So this is how it will be working. Now there is a one example I have mentioned. So if we just have a look of this particular example, at 30th September 2003, the closing inventory of a company amount to 386,400. The following items were included in the total at cost. So 1,000 item which had cost of 18 each. These items were all sold in October 2003 for $15 each, with selling expenses of 8,000. Five items which had been in inventory since 1937, when they were purchased for 100 you can say dollars sold on October 2003 for 1000 each of net selling expense. So what figure should appear in the company statement of financial position on 30th September 2003 for the inventory? From this particular example, if we just have a look, so uh, this particular item which they have mentioned, we have to use the regulation. We have to use basically, we have to utilize that particular law which is mentioned in the IFRS, like the lower of cost or NRV. So once we say the lower of cost or NRV, so we say from the rule point of view, if that particular, once we calculate the cost or net realizable value, so whatever you can say, whatever is the lower, we will be mentioning in our profit and loss statement. So from here you can see the cost that is 18,000 and the net realizable value is 14,200. And then that is the first item. The second item again, that will be the cost that is 500 and then net realizable value that is 1,000. So 18,000 has been used in the calculation of inventory. This should be replaced by 14,200 has been lower of the cost or NRV. Okay, because 18 and 14. So 18, you can say 14,200 is the less as compared to the cost. So that's why once we are recording that particular economic activity, we should record based on NRV, not on cost, because in the GAAP or maybe some other you can say accounting you can say standards, they might be recording based on the cost, and that's how it will be reflecting. That's how it will be creating a gap and impact at the same time in the financial statements. Okay, so I hope the other expense item it's mentioned here as well, like 500 has been used in the calculation for inventory, and it is still the lower of cost and NRV after adjustment. So the correct amount has been you can say used. So that's why we have you can say we don't have to do any kind of adjustment or problems. So we will be writing the same amount. So the rule is lower of cost or NRV. So whatever the lower, if the cost is lower, then we will be taking the cost amount, or if the NRV is low, then we will be taking the NRV amount. Once we are establishing, once now we are creating our financial statements. Then another you can say example. Yes, do you have any question or something at the same time? So we can.
Yeah, we have some questions.
Yeah, please. Please.
Yeah, so there are two questions.
Yes, please.
One is, what is the objective or the need to prepare a financial statement? On the first question.
Okay, what is the objective?
Yes.
Okay. So I will be taking this first question, the objective. As I already mentioned, financial statements must be because the financial reporting. So there are number of stakeholders who are connected with the business, who are connected with the business entity. So once, as you can say, business person, once I need, you can say, fund for grow for the expansion of my business, I need funds. So to whom should I approach? Should I approach to the general public, or should I approach to the financial institutions or banks, or you can say any other you can say loan, you can say companies who are providing these funds? Once I'm approaching to the general public, they will ask, okay, would you like to show us how does this particular project, or does this particular you can say organization will work, and what kind of you can say profits which we will be enjoying in future, and how much dividend which we are expecting as a shareholder, because this is their right. Then how I will be able to communicate, how I will be able to you can say give them trust, like, okay, if you are investing $10 in my organization today, then in future you will be getting this much dividend. But again, at the same time, uh, these financial, as you can say, reporting, these financial statements will be providing the analysis. Like if we are investing this particular amount in terms of budgeting, so we will be getting this much, you can say, profits, this much, you can say, dividends we will be paying to the shareholders. And at the same time, these financial statements, once we discuss in terms of, you can say, external bodies. So let's suppose the example of you can say governments, banks, institutions. As I already mentioned, governments are very you can say quite a big stakeholder in terms of the taxation. So they want to you can say put the tax liability on your company. But how does they will be applying each you can say tax liability for that particular amount. Now, you might say like the amount is 5,000, but they will say we are not sure that either you have calculated the taxable amount, but that taxable amount having some confusion, they have some differences. Maybe you will be making 10,000, 15,000, you can say profit. So again, to give them confidence, to give them, you can say, true and fair picture of your organization from the tax, you can say, point of view, from you can say other outside at the same time, you can say stakeholders point of view, giving them trust, like they should trust on your organization. So we have to establish, we have to create, we have to make financial statement, we have to you can say do the financial reporting things. So once we create the financial statements, so then financial reporting comes in, like okay, on which base, on which you can say rules, on which particular policies, on which particular protocols we are establishing financial statements. Okay.
So we are getting lots and lots of positive views and positive comments.
Okay.
And there is another question. What are
It's
the international accounting standards and IFRS which has been affected by COVID-19 pandemic and their impacts on financial reporting?
okay. Basically, the IFRS, now, as I mentioned, these are the guidelines state about you can say economic activity. How does we are recording that particular economic activity, and at the same time, if that particular economic activity have got some kind of, you can say, gaps, some gaps, or we are not able to, you can say, record on a quite right way, then they will be providing you can say then we can, as a business analyst, we can provide our suggestion, recommendation at the same time. Let's suppose you mentioned one COVID-19 you can say impact. So exactly that particular, you can say, issue you can say needs to be discussed at the same time in IFRS point of view, like on such circumstances, on such you can say economic recession, on such, you can say, business condition, how does that particular rule needs to be applied, or as I mentioned, they are the principles. So if we say the principles, so we can, you can say, make the amendment, we can, you can say, expect basically amendments, changes in future, which will incorporate with that particular, you can say, business situation or condition which is coming up, maybe in future at the same time, because this was one of the situation which we have faced, which you have still facing past 2-3 years. So that's the reason IFRS now, it's more, you can say, flexible when it's terms to make the application, but when it's come to gap, they are having their own rule, regulation, policies, which needs to be, you can say, according to them. So so that's why IFRS is more lenient.
Okay. And another question,
Yes.
it's like one of the learners is asking for want to get more clarification on the net realization value. They want to get
Sorry.
net realization value, the calculation.
Net realizable value, I think.
Yes.
Okay, very good. See, if you see the net realizable value, so we have the cost. At the same time, we have the number of units. Cost and number of units, we both have got there. So if you see the cost and number of units, so we will be getting different, you can say, values. We will be getting different results. When it's come to the cost, we will be getting per unit, you can say, cost that will be 18,000, item one. But at the same time, once we you can say calculate using NRV, net realizable value, we will be getting uh, uh, 14,200. That is a net result. So the net realizable value and cost, basically, having the contradiction in terms of which particular amount needs to be recorded in the financial statements, and on what terms. So accounting principle IFRS, basically, they have mentioned, once you can say establish the financial statement for your business, once you can say draft the financial documentation, then you need to take the value which will be lower. Lower, either the cost is lower or NRV is lower. So sometime for item A, as I mentioned this example, so you can see item A have got, you can say, less NRV. So that's why we will be taking NRV, you can say method. But in the cost, you can say item 2, we will be taking the cost method because it will be providing less value. So whatever the less, once we I can say establish the financial statement, because right now we have quite you can say time constraint, so I cannot you can say discuss in more details. So that's why
Yeah.
it's
I
just
understand.
giving an overview about each accounting standard which IFRS have established, and how does the application will be you can say helping the organization, will be helping the business analyst to you can say record, to you can say make the financial you can say instrument. Yes.
Oh,
Yes, any other
you can.
question?
For the time being, there are no questions. You can continue.
Okay, okay. Okay, so now another you can say law which is linked with like I mentioned previously, IFRS. So earning per share. So there is another you can say economic activity. First, now we discuss, we learn about the cost and NRV. Now we're discussing about the measure of hmm, earning per share. Once we discuss the measure of earning per share, so we will be getting the information like how does, if we you can say create, if we you can say if we write down one particular uh, standard application, how does it will be different from the gap. So basically what is earning per share, that is made the company performance separate you can say accounting standard IS 33, basically that is the standard which is mentioned, publicly traded quoted as you can say stock exchange market. Now how to calculate when it's come to the calculation, because all of these standards which are mentioned here, they are normally having their own rules, their own you can say regulation when it's come to the application. So here, if you can see here, they mention how to calculate the EPS, earning per share. So the basic EPS, net income minus preferred dividend, our weighted average number of common share outstanding. Now this is what you can say particular this is particular regulation which they have mentioned, like how does this will be working. So when it's come to calculating the earning per share, so we will be able to know how this will be helping for this will be you can say giving us the guidelines to create, to make financial you can say statements. And how does that particular amount needs to be calculated. Now in a basic you can say APS, what we have to do, we have to take the net income, then we minus the preferred dividend, and then we divide the weighted average number of common share outstanding. That's it. So this is the basically calculated formula, calculated you can say application for the IES 33. Then there is a one example which I have mentioned again. So from this example we can see they have mentioned 1st January there was some ordinary share issue, then on the 1st April after that they have issued some share, then 1st May they have issued some share, and then on 1st December also they have issued some share. So you can say Mike Limited you can say has year ended of 31st 12 11 following, or the shares took place during the year. So this is the information. So we have to create our financial statements at 31st December, and then this was the amount is shown. Now from this particular slide, you guys can see on January transaction. First, we have to take weighted average number of shares, which we need to make the calculation of shares, then transaction. Then 1st January to 31st March. So we can see number of share, and then how we calculated. So this is the amount 187,500. Then after that, we have another, you can say, share issued that will be 470,000 share issue. This is the amount, and that will be included on May. So 1st May to 31st, you can say October, it will come around 6 months. So for the 6 months, what we have to do, we have to simply multiply with by 6 divided by 12, because we have to take you can say exact numbers from 1st May, June, July, August, September and October, so there will be 6 months. So that's why we have to, you can say, divide with 6, and 6 divided by 12, so this will be the amount. Then they have issued some other shares that will be 125,000. So share, you can say, purchase. So 1st December to 31st December. So that will be taking only 1 month. So in the last month, once they have, you can say, issued some share, so we will simply take the amount and then divide by 1. So basically, what we have to see, when did that particular, you can say, share that was issued, and then how does that particular share, will be treated. How does, now we can say, from the calculation point of view, how does, will be calculating, because we are discussing international accounting standards 33, EPS, earning per share. So same way, for each and every economic business activity, economic, you can say, business affairs now, which is going on within the, you can say, organizations, they have established rules, they have established regulation like this. So this is the one of the example, which I have mentioned here. So you guys can see here the EPS, which is mentioned here, that is 12.38%. So according to IAS, you can say 33. Okay. So that is, you can say, another example which I have mentioned. So yeah, this is the first example. This is the second example. So from January to 30th September. So again, taking the 9 months. So January to September, it will take 9 months. So 9 by 12. Then 1st December to 31st December. So from September, October, November, and December. So there will be 3 months. So that's why we'll be dividing by 3. So this is how we will be making the calculation by using IAS 33 standard. Okay. So this will be the APS. Now, this particular APS amount, which is coming by using IES 33 standard, it will be different by using GAAP application. Okay. Then another, you can say, diluted EPS, that is diluted EPS. Basically, we companies issue once they need additional funds. So that will be basically on their current shares, they will be having, they will be required, you can say, additional shares, or they will be issuing. So that will be considered reduction in the earning per share. At the same time, the share options or warrants are exercised. Ordinary shares are issued upon the satisfaction or of specific you can specify the condition, and anti-diluted EPS increase in the earning per share. Now, first we discuss the EPS. Now we're discussing about the diluted EPS. So diluted EPS, net income minus preferred share plus payout to diluted securities. So this thing will be added, because in the EPS we only, you can say, minus the dividend, but here we need to minus the first preferred dividend, then we have to plus paid out to dilutive securities. Then we will be dividing with the weighted average number of, you can say, common share outstanding plus conversion of diluted securities. So from this example, you can see example, shares should be calculated based on the fair value of shares. Then A limited has an issue option to subscribe for, take the example of, you can say, 100,000, you can say, ordinary shares at 4 per share. The average fair value of one share during the year was 6, you can say, pound per share. The profit attributable to the ordinary share amounted to 25, you can say, 100,000, and then weighted average number of shares in issue during the last year were 100,000. Okay, so how to calculate? So this is the calculation method by using IAS 33 standard. So basic EPS, then this was the basic EPS which we have calculated in our previous slides, and now this will be the diluted EPS which is mentioned here. So share at no consideration increase in number of shares, then this much numbers, then number of, you can say, share that would have been issued at a fair value. So this will be, you can say, coming amount like this, and then option at no consideration, it will be like that. Basically, I'm not going to, in details for, each and every calculation, because we have, quite time constraint. So just to give an idea how to utilize each standard, how to utilize each, you can say, economic standard, we will be, you can say, we have to, you can basically go through a lot of clause, a lot of, you can say, principle, a lot of, you can say, methods to calculate the EPS of earning per share. for using IFRS application, and then earning per share using GAAP application. But again, they will be having the contradiction. And I'm not able to, you can say, put the example for GAAP as well, because it will be, getting quite longer. So I'm just giving the overview about the IFRS, because IFRS now, the accounting standards, they are more, you can say, exercisable in today accounting world. And normally, majority of the, you can say, countries, they are using IFRS standard only. So that's the reason I just, you can say, put only IFRS examples. And as I previously, have mentioned about the differences. So from the differences point of view, we discuss about the last in first out method. Once we discuss the gap, as well as because it will be neglected in the IFRS. So because of the in the LIFO, lots of, you can say, US companies, they are using the LIFO method. So because it reduced, profit now, so that's the reason, it will be reducing the tax amounts. But at the same time, once that particular you can say company, they will be exercising the same activity within the UK, or you can say other countries, who are using the IFRS application, then it will be, you can say, giving a different picture. So once the cost, it will be reduced at the same time, and at the same time, the profit, will be reduced. So once profit will be reduced, then again the taxable amount that will be applied for that particular activity will be reduced, and it will be, you can say, costing to the US government literally like $100 billion every year, just because of, this particular you can say LIFO you can say method, which GAAP is using, which US using basically. And like all the other, you can say, accounting bodies, they are still hoping, like, maybe someday they will be able to change, those standards. They will be able to not only change, but also, you can say, make the addition, make the improvement in terms of, you can say, IFRS. So that's why IFRS, it's a quite, you can say, globally accepted, you can say, principles throughout the you can say, different worlds. Okay, and then yeah, there is another, you can say, accounting standards which I really wanted to mention for that is IFRS 15, that is revenue as income arising of entity ordinary activities. Okay, so in this you can say in this particular um, sorry, in this particular accounting standards, they mention revenue as income rising of entity ordinary activities. Now, once they say ordinary activities, that ordinary activities will be narrated, will be interpreted differently in GAAP as well as in IFRS. And that's how, it will making the impact. That's how, it will creating you can say impact in terms of, like, okay, where, the differences are you can say arises, where, differences or gaps are, you can say, created. So the definitions of, each economic activity that will be narrated, that will be defined, for each particular accounting body, it will be different, and that's the reason they are having, this much gaps. So do not lead to the following of economic benefit to the entity, then exclude profit on disposal of asset, profit and loss, you can say, on non-consequent asset is recognized as other income. So revenue is one of the most important financial statement measure to both, you can say, prepare and use financial statements. Then it used to measure and assess aspects of reporting entity past financial performance, future, you can say, perspectives, as well as what is the financial health, of the organization. Then revenue recognition, it's therefore one of the accounting, you can say, topic that mostly, you can say, scrutinized by the investors and regulator as well, because based on the revenue, these financial, you can say, investor as well as you can say regulators, they will be, you can say, making they will be, you can say, putting, their judgments. So another thing, which I would like to mention when we are discussing about different standards like GAAP and IFRS and other, you can say, accounting bodies as well, there's a one word which you guys might have, you can say, seen, that is called recognition. Like how to recognize one particular expense. how does that particular same expense will be recognized by using IFRS or by using GAAP application. So there is a recognition, you can say, problem within the two, you can say, awarding accounting awarding bodies, because they will be recognizing each, you can say, economic activity differently, and that's how it will create a gap between the two. Okay, so again, the revenue, despite it's significant and increasing the, you can say, like no global world, and especially in the financial market, the revenue recognition requirements prior to issuance new, you can say, guidance, and those guidance now that I guess that will be, you can say, included in 2014. Yes, and that was different, with the US GAAP, because they established the revenue, you can see, clauses in 2014, I guess. Yeah. So at that time, they will be, mentioned, like, how does the treatment for IFRS now will be happen, and then once the application, the gap they have established around 2003. So from 2003 till, you can say, once in 2014 the guidelines was established by the IFRS. So they will be, after that they will be having the contradiction. Then financial accounting, you can say, standard board, FASB, that is basically a collectively board joined a standard, you can say, containing comprehensive principle for recognizing the revenue, for how to recognize that particular revenue, because the only problem, which we will be facing as a, you can say, financial analyst, as a, you can say, financial, you can say, people, that is recognition. How to recognize that particular economic activity, how to recognize that particular, you can say, item, which will, which will be mentioned in the balance sheet, income statement, or as well as in the cash flow statements. So IFRS 15 at the same time issued, having some issue with the FASB, and FASB, that is, you can say, GAAP is come under FASB. So ASC, that is 606, that is the standard. Yeah, I still remember. ASC 606 is the standard, which was, you can say, which was used previously by the GAAP, and then once IFRS established the 15 clause, so they will be having the contradiction. Then what they have done, they have made, basically, you can say, they made a collective effort. From that effort, they will make, they come to one point, like, revenue from the contracts with the customer will be, you can say, amendment according to the existing standard. So then GAAP, they have established, they try to, you can say, amend some of, their, you can say, policy, some of, their, you can say, information according to IFRS. Like, okay, if this particular, you can say, thing is happening, then we can take, we can, take the guidelines from the IFRS, and that's the reason it's a quite, you can say, popular when it's come to, and also, all these big four, you can say, firms, they are also recommending the application of IRS modes as compared to GAAP. And if you guys can see and just Google, the big four companies, the big four firms, basically, of accounting firms. So these accounting firms will be using more, you can say, IFRS application as compared to GAAP, because of the rules, which or you can say regulation, which is mentioned in the GAAP. So okay, yeah. Now from this point of view, I just wanted to conclude, the whole, you can say, session, because if we see from the accounting, financial accounting, you can say, application point of view, or you can say the application in terms of, you can say, that particular organization, that particular nature of business now, which are taking part into. So they will be having different views. They will be having, you can say, different views in terms of, like, okay, how does the financial reporting will be helping to my organization, to our organization, in terms of, you can say, growth, in terms of expansion, in terms of, you can say, fairness, transparency. At the same time, will be they will be attracting, like, more, you can say, shareholders. They will be attracting, more, you can say, investors, and they will be basically getting the confidence and trust. See, confidence and trust is something which is quite crucial for the organization, which is quite crucial for the companies at the same time to take to get from their internal as well as external stakeholders. But their only worry is how can we take the interest, how can we gain the interest of our potential investors, how can we gain the interest of our you can say potential shareholders. So that's how they will be taking the help of financial reporting. So it will be giving the holistic view of business, holistic view in a sense, like in one business. There are number of activities are going on. So normally, in businesses, we have got finance department, we have got human resource department, we have got marketing, we have got research and development, supply chain, and there are a number of other departments which are going on within the business. So financial reporting basically, will be helping to create that particular financial, you can say, instrument, which will be giving the overall picture, which will be, you can say, providing the overall health of the organization, like how does that particular department is doing, and how does that particular department is not doing well, and what are the differences, what are the gaps and laps which are going on within the business. So it might be, at the same time, it will be using for the internal communication point of view. So maybe there are some gaps which are going on in that particular department. So that particular department, what kind of, you can say, instruction, what kind of, you can say, guidelines which they needs to take. So it's not like the financial accounting reporting will be providing only the financial of it, but it will be you can say, providing us the information about you can say the human resource. It will be providing the budgeting for the marketing. It will also providing the research and development cost, which organizations are going to, which you can say, pay, or organizations are expecting to pay. And then it will be giving the view of, like, let's say, if they want to pay the research and development cost, then how to calculate the NPV, what is the, you can say, right NPV, net present value of that particular project, and then what are the other methods which will be used to see either that particular project is useful, is benefited for the organization or not. Then it will also, you can say, break down, you can say, teamwork into specified deliverables, because in the financial reporting it is very, you can say, precise principles for each and every economic activity. So for those activity, all the teams they will be working, you can say, based on the department, based on their specified teams. So as a whole, they will be collecting the information, and then in the first, you can say, first 10 minutes now, we were discussing about the overview of the financial reporting. So from the financial reporting from the overview point of view, it will also helping at the same time to the management in terms of decision making. And we knew, like, how does this will be impacting if businesses they are making just one, you can say, ineffective decision, if they are not able to make good, better, effective decision making. So how does it will be impacting to the whole, you can say, organization, to the whole business. So that's how it is not like the financial reporting will be giving us only the financial, you can say, data and information, like balance sheet, income statements, and all of you can say other financial related things, but it will be giving us the holistic view of the business, holistic, you can say, point of view of the business, like how does this particular business is doing, and what are the growth chances in future. Then once we discuss about the financial reporting, so it will be communicating the financial goals and performance, and that communication, again, there should be some certain patterns, there should be some certain rules, there should be some, you can say, certain regulation, there should be some hierarchy, like whom to report, how to report, what to report. So once we discuss the communication, so it will make more easy, financial reporting basically, it will make more easy to the stakeholders, to the you can say, either they are internal or external, to make the communication. And once they are making the communication, they are communicating right information, because information should be smart. If information is not smart, like information is not specific, it is not measurable, it is not attainable, it is not you can say realistic, and also timely, then that information is no use. because whatever the decision which you can say higher management they will be making, they might not be able to make good or better or effective decision, because they are not having the confidence on that particular data and information which they have taken. But at the same time, if that information which will be, you can say, analyzed, summarized, at the same time they have, you can say, interpreted by the business analyst, by the auditors, or you can say by the other, you can say, financial bodies. So it will create, it will boost the confidence of the business, of the, you can say, owners, at the same time entrepreneur, or it will give the, you can say, confidence to the general public as well. Like, okay, this particular, you can say, business is doing well, so I should, you can say, invest into this business, so then only my investment will be safeguard. Because the first and foremost, you can say, the business conception which we learn and we discuss, that is, businesses exist to maximize the wealth of shareholder. So if they are not able to maximize the wealth of shareholder, then they are having, you can say, no confidence, no to taking the organization to the next level. But how can we take the organization to the next level? How can they maximize the wealth of shareholder? This is only, as you can see, possible once they are using the application. Once now they are using the, you can say, effective application of financial reporting. Then use of, you can say, available resources. Exactly. Once each resource, once it will maybe make the procurement, from the procurement department. So when it is acquired, when it is, you can say, acquired by the businesses, so from that date, from the make of, you can say, acquisition, till, you can say, make it, after, you can say, doing the setup cost and all, after make it, you can say, a workable, condition, and then it will, try generate the income, it will generate the revenues and all. It has no, you can say, quite, you can say, big quite a good history. So from that point till the end, till we are disposing of that asset, it will give the clear picture, like how to utilize that particular asset. And utilizing, in a sense, effective utilization, efficiency utilization. So if we are not able to, you can say, businesses, they're not able to utilize that particular asset effectively or efficiently, then again that will be a problem for them. So that's the reason they are not able to, you can say, make these resources now in quite efficient way. So they will be using these resources in a very ineffective way. So that ineffective way will be creating the hurdles, will be creating the problems for the businesses. And uh, again, at the same time, they were not able to make the growth of the business. Financial reporting, that is again is some essential management skill. It should, you can say, it should be, you can say, applied, it should be used, financial reporting, you can say, application by all the individuals, all the, you can say, personnel, or the, you can say, people, or you can say employees who are working within the organization, because it's a skill. Once you have got this particular skill set, then only you will be able to, you can say, take your organization to the next level, and you are able to, you can say, manage the show. Then it will be give the clear understanding. Again, the clear understanding is a very, very important, because once you having the clear understanding of the goal, objectives, or you can say mission and vision of the organization, how does now it will be, you can say, taking to the next level, then only organization will be able to grow, and they will be able to, you can say, do well within the business, you can say, within the economy, or in the center within the business competitive sector. Because see, in this in today's world, if organizations, they are not able to communicate effectively, efficiently, their goal, their, you can say, objectives, at the same time, their mission and vision, and then employees, you can say, the people who are working within the organization, they are not able to relate with the organization. So maybe the organization is going somewhere, and then employees, or you can say the personnel who are working within the organization, they will be going somewhere. So if they are not going both in the right direction simultaneously, then it will be creating, you can say, it will be creating, you can say, hurdles for the organization to make the growth. And then last but not the least, that is informed decision, as I mentioned. Decision making process is a very, very, you can say, important from the business, you can say, point of view. And it should be, you can say, taken at it should be taken very seriously, because one particular ineffective decision will cost organization $100 billion. So we can see, there are a number of examples which we knew already. There are a number of businesses who are not able to make basically good, better, or effective decisions, and at the same time timely decision. That's why their growth and also the growth level. If we see in today's world, it's go down, and also it will impact the whole organization. It will impact the whole history of the organization. So decision making part, it's a very very important and a crucial, from you can say financial reporting point of view. But that decision making should only be you can say able to do the businesses, or you can say organization people, they are only able to do. And especially when it's come to the decision making, yes, the CEO, the top level management, they are only able to do the informed, good, better, effective decisions once they have got the valuable, once they have got the smart information. And the smart information which I have already discussed, that information should be specific, that information should be measurable, that information should be realistic, timely, and attainable at the same time. So once they are applied this objective, so financial reporting will be giving the application, will be giving the you can say information and guidelines how to make your objective smart, and how to make your data and information smart. Then only it will be helping the top level management to make good, better decision making for the growth and development of the organization. Okay, so this is how we can sum up our financial reporting seminar. And at the same time, let me know, because all of these, you can say, points which is mentioned here, these are the same points which we discussed. That's valuable insights about the organization, debt and ability to pay, profit and losses, you can say, compared to the past, investment requirements, expenses compared to the revenues, and value of document. So all of these concerns we have already discussed within our you can say whole session. So yeah, these are
Okay.
the additional criteria. One second, please,
Yeah, yeah,
Akash.
yeah. No problem. No problem.
Okay,
Right.
so these are the some additional you can say information where you guys can learn about the financial reporting. So these links are very very useful for all of you. So you can take out and just you can say make yourself aware, make more stuff, you can say more you can say updated in terms of financial reporting, the applications, and links I have already shared. And I guess Mr. Agra will also be sharing the same to all the audience once we are sharing the this particular document. Yes, 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 Mr. Agra. No.
Yeah, so many positive comments are coming from chat box.
Okay.
Everyone loved your session,
Oh, thank you.
and yeah, everyone loved it. That, there are so many thank yous are coming on the way. So thank you, thanks a lot.
No problem. No
There
problem.
are questions also, interesting questions.
Yes, yes, please.
Yes. So the first question from one of the learner. She is asking that her company were not operating in the COVID, so they did some renovation in the office and attended some international courses. So
Okay.
how do they prepare a financial report?
Uh, See, the financial reporting, I think we have got one more question previously. That was about the COVID. So COVID is, one of, you can say, events, which came, into our lives, and it impacted, the businesses as well as, the individual life. But at the same time, once we say, how does the financial reporting will be, you can say, will be establishing, will be able to, you can say, provide the guidelines, will be able to, provide the information for recording that particular event. So that not you can say basically it will be the same way, but a little bit you can say updated, you can say version that they might be, you can say, provided. Because anyhow, the basic rules, the basic principles, sorry, because rules which we discussed, that is mentioned in the gap. So the basic principles which are mentioned in IFRS, So they will provide a detailed information, and those information will not be, you can say, will not only be feasible, for one particular, you can say, condition. Like, if the business is doing well, then only these standards will be, you can say, workable. Or the business is not doing well, then only, or the business have got this much growth, then only we will be able to, make the application. It's not like that. Once they establish one particular accounting standard, once they establish one particular principle, that particular standard or principle will be providing the detailed information about all the, you can say, economic activities, or any economic unforeseen, any, you can say, economic, you can say, hazard which will impact the business. So it will be providing the, you can say, quite, you can say, guidelines, and it will be covering. See, we have faced the COVID past 2 to 3 years, but there are some other, you can say, economic events as well. Sorry, there are some, you can say, uncertainty, you can say, climate changes events, like sports floods. There's some, you can say, countries, they will be having floods, earthquake. So all of these, you can say, uncertain activities, how to perform, how to, you can say, regard, under these conditions, they are providing the guidelines, and it is mentioned there. So it will be, you can say, providing the detailed guidelines, how to, you can say, how to basically do the financial reporting within that circumstances. So it's not like, it's one of, you can say, particular, even unforeseen, basically, even it will be providing guidelines. It will be providing as a whole. As I mentioned, it's a holistic, you can say, principles. So it will be providing the details of all the unforeseen economic events that might happen in future as well. Yes. Any other question? I hope it's clear.
Yes, yes, yes. So yeah, that's very much clear. So does it affect the balance sheet or the profit and loss statement if any scenario, pandemic scenario comes? So how will it affect the balance sheet or profit and loss statement?
Exactly. As I mentioned, the financial reporting, basically, it's a sequence. It's starting from the journal. Then from the journal, whatever the entries we have recorded, it will be going to the ledger. Then after the ledger, it will be going to the trial balance. Then after the trial balance, it will be going to the statement of financial position, and then it will be included with it will be connected basically with the cash flow statement. So once that particular activity is recorded under that situation, so it will be impacting the business, you can say, profits. Either, the profit will be higher or it will be lower. That is according to, you can say, terms and conditions, which are going on within that particular, you can say, country economy. And this is basically, financial reporting is a very much, you can say, linked with the business environment and the economics of the country. Like, how does the economy of the country is doing well. If they are not, you can say, able to, you can say, do well within the economy, then it will be impacting the, well, you can say, financial reporting fair as well, because they are both are, interconnected. Okay.
Another question, it's from accounting standard only.
Okay.
How do we apply international accounting standard on stock item that was impacted by forex increase or decrease in the reporting currency?
Okay. Again, the question, which are coming, they are very much similar, to one, particular. So the guidelines, which are mentioned in the accounting standards, either it's a gap or IFRS, it will give the impression for not for, choosing one particular condition. It will be giving the detailed information about all the possible, you can say, events which are going on within the organization. As I mentioned previously, once we are making the trading profit and loss, so normally, from the trading profit and loss point of view, we will mention only direct expenses who will be incurred, during the procurement of that particular asset which we acquired for the economic benefit, because we take the asset to get the economic benefit. So from the acquiring, from the procurement till, you can say, taking the setup, so how much cost now we have paid. After that, what are the other, you can say, administrative, or you can say, marketing expenses, which we have to pay. So that will be indirect expenses. So all these direct and indirect expenses will be included. And this particular, you can say, conditional, which is mentioned in this question, that is also considered, because anyhow, all the businesses, they are, once they are doing the budgeting, so there will be, some risk levels. So that risk level, you can say fraction that will be increased, because now they knew the situation, it's very risky. The situation is not, you can say, feasible for the company. Maybe there are some, you can say, organizations who are located and they have some geographical boundaries, like they're facing some kind of, you can say, calamity changes. Oftenly, let's go take the example of Japan, Tokyo. So they will be having oftenly facing earthquake. So in that way they can, you can say, they can basically do their budgeting, and also they can see how the risk level will be mentioned within the organization, because again there are a number of things which are interconnected with the financial reporting when it's come to the principle, when it's come to the application. So we have to see what are the local, you can say, conditions of the organization, of the, you can say, economy at the same time, and how does that particular geographical location will be impacting to the organization in terms of risk. Okay.
Another question for calculating EPS, which is
Okay.
the best rule? Profit before tax or profit after tax?
Normally the EPS, which we calculate, that will be calculated after the tax.
After the
But
tax.
again, there are see, once we are discussing about the financial reporting, so I forget to one mention one report, one particular, you can say, concept, that is, once we window dressing of the financial instruments, financial documentation, where organization, they falsely written down some expenses, some you can say revenues which are not exist, ghost revenues, ghost you can say expenses. So again, plus minus is still there.
There are exceptions.
Yeah, exactly, there are differences.
Another question. His name is Valence. He is from Tanzania. So he is
Okay.
asking that how do I recognize revenue from project that take a sabbatical period of time, say 10 years?
So how can we this question was quite long.
I am repeating once again. How can I recognize revenue from projects that take a sabbatical period of time, suppose 10 years?
Okay, for the revenue recognition, as I mentioned, once we see the project, so from the project, we basically, first of all, we calculate the NPV, net present value of that particular project, either that project is feasible or not. So once we calculate the NPV, so the results, once we see if the results are coming, you can say positive, then only we will be accepting the project. Other, we will be reject the project. So there are some other, you can say, financial reporting tools. We say basically these are financial reporting tools which we use to get to know the information about the project feasibility. So there will be NPV, IRR, MIRR. So all of these, you can say, financial terminologies, tools, basically we're using to get to know the information about either we are going to accept or reject the project. So it will basically give you a very clear information, because all these data information, which you have taken, from that project, you will be plotting into the application of IRR, or you can say NPV or MIRR. So it will give you the clear picture, either you are going to accept or you are going to reject the project. Because this is financial, you can say, data. That financial data, once now it will be analyzed using IFRS application. So it will be giving the clear picture, either we are accepting or rejecting. And then that you can say tools which I have mentioned, that is NPV, net present value, then IRR, that is internal rate of return, then IRR, and also there are some other, you can say, tool as well, which we use to get to know about the feasibility of the project. Okay.
Okay. Another question is what is the best way to treat a figure carried in receivables for over 4 years?
What's the best way to
Uh, treat a figure carried in receivables for over
sorry,
4 years. What is the best way to treat?
sorry, the question is not clear. A
Proceed.
receivable, I got the you can say information about the receivable only, but I'm sorry, I'm not able to understand the other part.
Okay. So we can go to the next question.
Okay.
Uh, in a non-profit organization, what is the
Mhm.
best method a financial manager can adapt to ensure a proper utilization of resources?
Yeah, exactly. The financial reporting again, it will be gives it will not only give the information about the profitable organization, it will also give the non-profitable organization as well. So once the non-profitable organizations, once they are you can say conducting the their you can say activities, their business affairs, so it will be applied same as the profitable organization. But yes, there are some you can say there are some you can say limitation in terms of calculation of donations, calculation of you can say charitable, you can say QCDs. We say we use this particular terminology, that is QCDs. So what are the qualifying charitable donation? So that qualifying charitable donation, how to calculate, the whole method is mentioned within the financial reporting, and the also the financial standards. It will include information how does that particular qualifying charitable donation will be treated. Normally in the UK companies, the ones they you can say tax files, their documents. So they will be having these particular you can say rules within their financial statements. So they say it is mentioned like how much the qualifying charitable donations which were made by the organization. So it is mentioned there as well. So for the charitable organization, QCF, there is a one you can say method we use, that is called QCF, qualifying charitable donations, to write down to make the financial reporting, to basically exercise the financial reporting. Okay.
Another question is, how can ICT contribute to the development of financial management?
How can?
ICT, information and communication technology.
Yeah, as I mentioned, in terms of the information, and we are basically, we are there's a bombard of communication. Once we see the internet, once we see the social media, once we see even the billboards, or you can say once we see the other you can say government you can say archives, libraries and all. So there is a number of you can say financial data information which is available. Once we are making analysis, once we are making we are writing about the article, or we are doing the research. But at the same time, which particular information we will be taking, that is a big challenge. And it is still you can say big challenge for all of us in today's world as well, like which particular information which needs to be taken, and which information which needs to be avoided.
Yes,
Because
it is
that
a
that information, it is linked not only from the ethical you can say point of view, from the you can say transparency point of view, but that information, it should be you can say, it will be linked with the culture of that particular country, in the customs, it you can say linked with that particular you can say geographical area, demographics also. So it's a quite big challenge for you can say us, for you can say analysts, to get to know about the right information, and which particular information that needs to be communicated in that particular you can say country, in that particular you can say geographical location. So once for you can say financial reporting, again if the information you can say applied with the smart objective, so we can say that information is you can say trustable by applying the smart objectives. So there are some other you can say models, there are some other you can say tools as well, which we will be using to you can say basically filter the information. So which particular information which is useful for the decision making of the organization, for the you can say financial reporting point of view, and which information which will not you can say give us the good results, which might you can say impact you can say our organization in you can say negative way. So we need to avoid.
uh, another question, it is quite relevant with the PPT. So
Mhm.
what importance and relevance are IAS 1, IFRS 1, IFRS 9 and IFRS 15 to microfinance bank report? How is it important and relevant with your standard?
Micro financing, exactly, all of those businesses who are generating revenue. See businesses, see even the microfinancings, once they are providing the loans, once they are providing the financing, so from the interest there will be the revenue for them. They generate new revenue from the interest amounts which we are paying, once we are taking the you can say once we are basically taking the loans. So how to record the revenues, it will be the same application which have mentioned for the businesses as well. So it will not be changed. because as I mentioned, it is not particular set of some businesses, some you can say 4 or 5 businesses, which I just wanted to you can say mention as example. Like it is not like no, there are 3, 4, 5 businesses which we have to take care of the financial reporting, and other businesses it will be neglected. No, once they say the revenue in terms of any organization, any type of business, any type of you can say nature of business, which is you can say commencing, which is conducting, and which is you can say conducting the you can say economic or business activity, it will be applied the same.
Okay.
Mhm.
So after this, we don't have any other questions for now.
Mhm.
So thank you for once again, and
My player.
everyone enjoyed it a lot. Everyone is giving positive feedback. So thank you once again for being a part of this webinar and giving us such an
Thank you.
informative webinar session.
Thank you, participant, and thank you, Mr. Agra, as well, for your valuable feedback.
Thank you everyone for being part of this webinar. Once again, let me remind you uh, that we have aligned courses with this postgraduate diploma in financial risk and management and essential of accounting system and procedure, which will help you to understand the fundamentals and advanced feature of finance and accounting. You can check us out on uniathena.com. Links are also provided, and you will receive the certificate of participation via the registered email. You can revisit the webinar on the Uniathena YouTube page. And thank you once again for joining today. We will see you next time. Thank you. Thanks a lot.
Thank you very much. Thank you very much, Mr. Agra.